Yeah, and thanks for having me this morning. U.S. stocks remind me a lot of what China was, say, 10 or 12 years ago in investors' mind. It was impenetrable. Nothing could really go wrong in the story. It was really over-owned by a lot of investors. In many cases, had never owned those stocks before or hadn't owned them as much as they had. And now look at where we sit on these Chinese discussions today in terms of where the economy is relative to then, and really how the stock market's performed since then. So I just say that because you always have to be very worried about popularity and the over ownership, and really that's the juncture and the place the United States sits in relative to the rest of the world's stock markets today.
Indeed, and the reason I ask the question is because there are some analysts who are now saying that the only catalyst for higher markets is rate cuts. But look at the situation in China. We've seen this slew of negative activity data for July. The PBOC is cutting rates. What's your view on the damage that we're seeing in the Chinese economy, and how concerning is it for the outlook in the United States where you are?
It's a great question. To your point, the Chinese market is dealing with a credit crisis and really a kind of a capital markets issue. So trying to consolidate the local government debt, trying to get these property companies under control, that's a credit issue. That's a really unique issue to China. In effect, the ghost cities and the overdevelopment of the last decade plus is really coming home to roost now. It's just taken a very long time. Yes, you pointed out Evergrande was dealt with a year ago, and we're still seeing the rolling of that. So, cleaner balance sheets are going to come in the future, but there's got to be some pain in the interim. I just point that out because that's vastly different than the problem in the United States. The United States is really the strength of the economy. It's the strength of the labor markets. It's the Federal Reserve raising rates to what seems normally would be a very tight, restrictive level in short-term rates, and yet the economy chugs along and labor markets have no issue. I think you could drive a Mack truck through the difference between the Chinese economy and the woes of its equity markets and the strength of the U.S. economy and really the popularity of its markets. It's just two different worlds. But I only pointed out because you got to remember the United States a decade plus ago was the problem child. They created much of the problems of the world. So it wasn't dissimilar to where China sits in some respects. Humility always breeds success, historically speaking, in economic growth and stock market returns. And I think that just kind of shows you the polar opposite nature. Now, one other thing I'll mention, despite all the weakness in China right now, look where oil prices are. Oil prices are swallowing Chinese problems like there's no issue at all for oil.